In this video, I'm going to explain an iron condor options trading strategy, step by step, from the perspective of a professional options trader. So if you're trying to understand how an iron condor option spread works, why it's important, and how it can help you become a better trader, then this is the video for you. Now, if you don't have time to watch the whole video and would just rather get our cheat sheet explaining the most important things with iron condors, you can click the button that should pop up on the corner of this video or go to the link I have in the description. My name's Scott Bauer, and I've been trading for over 30 years. I'm a former Goldman Sachs VP, and today I'm going to teach you how the real professionals on Wall Street use iron condors to potentially find big profits in the markets. Don't forget to hit that like button nearby and subscribe to our channel if you want to learn more about options trading and our favorite options trading strategies. Let's dive in. So let's take a look here and let's discuss what is an iron condor. And I'm going to make some notes here for everybody. What is an iron condor? Man, does that sound complicated. But when you break it down, as is the case with almost every type of option strategy, every strategy is really kind of just a subset of another strategy, or maybe a combination of a couple strategies. So an iron condor, it combines a call spread and a put spread. That's all it is. And again, it sounds so, oh my God, I can't do this, but that's really all it is. And typically the way that we trade iron condors, you can buy them or sell them. I will always look to sell an iron condor, which means selling both a call spread and selling a put spread. Now, why would we ever do that? So why would we ever want to sell an iron condor? What would be the optimal situation for that? Well, really, I look at two things, okay? Number one, an iron condor is best when you're looking for a stock to remain range bound. What does range bound mean? Well, trade in a range and think about it. If we're selling a put spread to the downside and selling a call spread to the upside, we don't want either one of those to hit. So we look for the stock to remain in a range. Look for stock to remain in a range. Now, when is the optimal time to do that? Well, the optimal time to do that typically is when volatility, option implied volatility, is expensive. And why is that? Well, when volatility rises, options get more expensive. Premium levels get more expensive. Extrinsic value levels get more expensive. We would rather sell options when they're expensive and not when they're cheap. So optimal time to sell in IC is when options are expensive or implied vol is expensive. Okay, let's take a look at a firm. Okay, I've got a firm up on the screen here. And without even looking at expected move or option pricing right now, we can see a firm is squarely trading smack dab in the middle of that red line and this blue line, right in between the 50-day and the 200-day moving averages. That could be one of those optimal times where you look at a chart, you look at some analysis, and you say, all right, it's going to take a lot for that stock to break out of one of these two ranges, either this 50-day on the upside or this 200-day on the upside. So I think for a period of time, and we determine what that period of time is, the stock is going to remain in the middle there. Okay, so what are those 2 points? Well, on the upside, the 50-day moving average is trading at around 140. The 200-day moving average on the bottom is trading at 90. And you can see where we're trading right now. The stock is almost smack dab in the middle. okay, almost equidistant between the bottom and the top of the range. That is typically a very good place to sell an iron condor. Now, as with any other type of strategy, you can always choose the length of time to your trade or the expiration. Your expiration could be just a couple days out and use weekly options, or it could be a week out or 2 weeks out, 4 weeks out, 6 months out. Obviously, the longer you go out in time, the longer the expiration, the greater the amount of premium there's going to be, the more credit you'll be able to collect. But keep in mind, also, the longer you go out in time, that gives the stock a better chance of moving outside of that range. So typically, I like to sell an iron condor with no longer than 2 weeks to expiration. I don't want to keep a trade out there where the possibility of a stock moving outside of a range is big, okay? I want to use technical analysis. We're going to use something called the expected move right now to figure out which strikes are ideal. But again, what is the best predictor of what may happen to a stock tomorrow or the next day? It's what's happened yesterday and just recently in the past. And the longer we go out in time, the more possibility there is of that stock really trading outside of a range. So let's take a look again at a firm here. And we've got 90 to the downside and 140 to the upside. By selling a put spread to the downside with a break even somewhere around 90 and selling a call spread to the upside with a break even of around 140, that's my goal. So I'm going out here to, I've got options out a couple weeks out here. So let's look at what the 95-90 put spread to the downside and the 140 call spread to the upside is. And if we look at those combined together, we see we get a price of, had the wrong side there. There we go. We get a price here of about $1.20. Okay. Now, I can tell you right now, that is not something I would want to sell for $1.20. And why is that? Well, let me bring the white board, the document back in here. Okay. So by selling both a call spread and a put spread simultaneously, we are collecting premium on both sides. And again, the goal of an iron condor is at expiration for the stock not to be trading outside of one of those short strikes. We want the stock to stay in a range. That doesn't mean we can't remove, take off, close that trade before expiration, but that is the goal. Now, when I sell an iron condor, I look to collect approximately, okay, 50% of the width of the strikes on both sides. So what does that mean? Well, if we go back to what we had set up here, you can see what I have set up here is selling a $5 wide put spread and a $5 wide call spread. The 95-90 put spread to the downside, the 135-140 call spread to the upside. Now, what many people don't understand, okay, is what the maximum value of this iron condor could ever be. Now, think about it. If we sell a put spread, we don't want the stock to go down. If we sell a call spread, we don't want it to go up. Okay? Now, what happens if it does move outside of one of those ranges? What if the stock really tanked here and blew through on the downside both of our put strikes, and let's say went to 75? Or on the opposite side, let's say the stock really rallied, blew up to the upside, went through both strikes to the upside, and went to 150. Okay, so let's get this back here. The maximum value of an iron condor is the width between the strikes. Okay, well, in this example right here, we've got the width between the strikes as $5 on both sides. $5 wide put spread, $5 wide call spread. It cannot be worth $10. Okay, the maximum value is the width between one side of the trade. Now let's think about it. I'm going to put this up here on the whiteboard again. Okay, we are looking at the Affirm 95-90 put spread and the Affirm 135-140 call spread. We want to sell both and ideally sell that for half of what the width on either side is. Ideally, we'd want to sell that for $2.50. Collect half of our maximum value. Now, why is that? Again, if the stock goes to, let's say, 75 at expiration, the put spread will be worth $5, but the call spread will be worth zero. Now, look at the opposite side. If the stock goes to 150 at expiration, the put spread will be worth 0, but the call spread will be worth $5. So you can see by that example right there that the value of an iron condor can never be more than the width of one side of either the put spread or the call spread. So in this case here, maximum value is $5. If I really want to collect half of that up front, I'm looking for a credit of $2.50. So let's go back to the charts right here. And the one that we had just put up here, we could only collect roughly $1.20. Okay, why isn't that good? Okay, why isn't that good? Well, if we only collect $1.20 and the maximum value of this trade is $5, then we are risking, at a worst case scenario, which is how we always want to determine our reward to risk ratio, which we must do on every single trade we make, then we are risking $3.80, right? How do we get that? Well, max value of 5 less the $1.20 we collected equals $3.80 that we can lose or risk. We always need to figure out reward to risk on every single trade we make. Remember, every trade you make has some level of risk to it. The key is to make sure we get paid the appropriate amount for the risk that we are taking. And if we don't, you can't get caught up with that old adage, FOMO, the fear of missing out. Doing this for over 30 years, folks, I have absolutely learned, and it is imperative. I try and teach my students, if you cannot get paid the appropriate amount of reward for the risk you're taking, move on to the next trade. There will always be another trade to make. So if we calculate our reward to risk here, we can only make $1.20 because in an iron condor, as with any credit spread that you trade, the most amount that you could ever make is the amount that you've collected up front. So regardless, I can only make $1.20 here. So my reward to risk is $1.20 divided by 380. Okay, what that really equals is about 0.33 to 1, thereabouts, approximately. That's awful reward to risk. I am taking way too much risk here for my potential reward. Okay, hopefully everybody understands that. Let me graph this out for you here. Okay, if I were to put up my risk chart on this, and we're going to put this out to expiration here. Okay, what you can see there we go. Sorry about that. What you can see is this big curve, this big bell curve. Okay, well, if I look at this here and draw a line, where's my break even? My break even is right here and right up here. Okay, that's my break even, meaning I need the stock to stay in the middle of that range to make any money. Now, how do we determine what that break even is? Pretty simple. The break even on an iron condor like this is the short strike plus or minus the credit received. On the downside, remember, on the put spread that we sold the 95-90 put spread. So the 95 put is our short strike. On the upside, we sold the 135-140 call spread. So on the upside, our short strike is what? 135. So we take our short 95 put, short meaning the one that we sold, less our credit of $1.20, our break even to the downside would be 93.80. Anything below 93.80, we start losing money. On the upside, we take our short 135 call plus our credit of $1.20, and that equals 136.20. So we have now very easily defined our break-even levels at expiration. 93.80 up to 136.20. And if I go back to my chart right here, that is pretty much what these levels show on this chart. Again, the most I can ever make, and the reason why the top part of this graph here is very limited, the most I could ever make is that credit that I received, or $1.20. Okay, so remember, in an iron condor, just like any other credit spread, the most you can make is $1.20. But when you are calculating your reward to risk, when you're calculating your risk allocation towards that type of spread, you need to consider not the credit that you've received, but actually the maximum risk to your position, which we identified here as $3.80. Okay, now, what happens if the stock does stay in the middle? What if it gets closer to expiration? Do we have to let it go all the way to expiration? No, we can always close out the position. You can always close out your call spread. You can always close out your put spread and just take the risk off. Okay, so let's go out, rather than this December 17th that we're looking at right here, let's go out a couple weeks further. where we know we're going to be able to collect a little bit more credit, use the same strikes, and let's see how much credit we could sell this iron Condor for. If we still thought going out a couple weeks from now that the stock was likely to remain in the same range, okay, now, and I just did this again, I need a negative here for the one that we're selling. Okay, now this credit is upwards of about $2. Now I'm getting closer. Maybe still not in the complete sweet spot of the amount that I want to collect, but it's getting a lot closer. Okay, does everybody see that here? $2. So on a $5 wide iron Condor, again, selling a $5 wide put spread, selling a $5 wide call spread at the same time. If I collect $2, what is my maximum risk? Okay, remember, maximum value is only the width of one of the spreads. $5 less the $2 I've collected, $3 risk. Okay, so how do we really figure out if those strikes we are using are the appropriate strikes to use or not? We don't really want to just kind of, look at this chart here. Let me go back to the chart. We don't really want to just go back to this chart and say, that looks like a real good area to say this stock is not going below here and it's not going above here. But we really want to use some analytics. We really want to use some math to our advantage. And what I always do on every single trade that I make, on every signal that I send out to our students, we always want to calculate what is the market expecting to happen to that stock? How big of a move is the market expecting that stock to make up until a certain period of time? And we can measure that by using the at the money straddle, or what's also known as the expected move. The expected move that the market prices in, everybody, prices in a move in either direction, up or down, up until a certain period of time with a 68% probability. Okay, I don't want to get too technical, too far into statistics here, but for those of you that are, real comfortable or remember statistics when you maybe took a class in high school or college, 68% probability is also known as one standard deviation. I like my odds with 68% rather than just saying, I've got a 50-50 chance. So if we go out to this December 31st expiration, the way we measure the expected move is to look at that at the money straddle. At the money meaning look at the call price, look at the put price for the strikes which are closest to where the stock is currently trading. So with the stock trading right now 112.69, let's focus in on the 113 strike options. The call options trading 10.75, the put options trading 10.90. If I add those together, I actually get $21.65. Okay, 10.75 plus 10.90, 21.65. When I go back to the whiteboard now, I'm just going to use $22 as the number just to go through math a little bit easier for everybody. But that is what the market is expecting a firm to move in either direction by December 31st expiration. So what we do to figure out the expected range, which is so important when choosing our strikes properly. Okay, let me get back to, okay, here we go. A firm was trading 112.70. The December 31st at the money straddle. Okay, at the money straddle again, which meant adding together. Oh, there we go. That's even better. Add together the call and put prices of the strike closest to where the stock is trading. Okay, So if you remember, and I'll look at it again one more time here, we were looking at the 113 straddle, and it was 1075 and 1090. A little different right now because we're actually looking at this in a live environment, but it was 1075 and 1090. Okay, so the at the money straddle, 1075 and 1090 for both the 113 strike, call, and put. Add those together, $21.65. That's the expected move. Okay, that is the expected move. So if I then take, and remember I said we were going to use just $22. Remember, what that is telling us is not direction. It doesn't tell us the stock is moving up or down. It just tells us that is how big the market is expecting that stock to move. So if I take where the stock was trading, and I'll round it off to 113, okay? 113 plus or minus $22 gives us an expected range of $91 on the downside up to 133 on the upside. 113 less 22 is 91. 113 plus 22 actually is not 133, it's 135. Good thing I just double checked my math there. Okay, so with a 68% probability, the market is saying between now and December 31st expiration, a firm is going to trade in this expected move range of 91 on the downside, 135 on the upside. That is really the key area where I want to look to sell my iron condors, to sell my put spread down there and sell my call spread up there. So if we go back to our example here, okay, we were looking at our break-even levels, 93.80, 136.20. 93.80, 136.20. Didn't like that. Okay? Didn't like that at all. But then when we looked at the new iron condor, when we moved out to the December 31st expiration, we came up with a value of just over $2. Now, if I look at that, now my break-evens really come in a lot closer to the expected move. Okay, so the break-even on the December 31st iron condor, selling it at $2 would be 95 less 2 or 93 on the downside, 135 plus 2 or 137 on the upside. That is really how I determine whether I am receiving enough credit for the risk I have. In this instance right here, we were collecting $2 and risking $3. Okay, do you all remember why we were risking $3? Because again, the maximum value of an iron condor is the width between either the call spread or the put spread, not both. In this instance, both spreads are $5 wide. Even if the stock went to zero, even if the stock went to 1,000, could never be worth more than $5. So in this scenario here, I'm collecting 2, I could lose 3, not good enough for me. So what that tells me, folks, is volatility or premium is just not expensive enough. It is just not expensive enough. And when I look at the chart here, it's okay. Volatility is fair. It's okay. I don't really want to sell it there. If I could get closer to half of that value of what the spread could be worth, then I'd want to sell it, folks. All right, everybody. So that's really a brief kind of summary of what an iron condor is. And the key to remember with trading different option strategies is don't ever be intimidated just by the name of a strategy. Once you understand option basics, most strategies are just the combination of those option basics. And in the case of an iron condor here, all it is the combination of a call spread and a put spread. Again, I typically like to sell iron condors and collect premium. So thanks everybody for watching. Thanks for listening in. Remember to like, comment,